Good afternoon and welcome to today's tax update webinar. My name is Natasha Wilson. I'm a manager here in the Tax Advisory division at Vincents. I believe we've got a mix of staff and other advisors and perhaps some clients in on today's webinar, so I will try and cater the delivery of the content as best I can to all those audiences. If you have questions throughout the webinar, or if things come to mind, then probably the best way to deal with that is to contact me via email or phone after the webinar if you'd like to discuss anything further. So my contact details are just there. And as usual, the important disclaimer that the information provided in the webinar is general in nature only, so any suggestions need to be considered carefully with your own particular circumstances. So if you do need specific advice in relation to anything that's been discussed, please feel free to reach out to me. So just a quick overview of what I'm going to be covering today. So firstly, I'm going to go through some recent developments in the world of employee versus contractor. So looking at the definition for superannuation guarantee purposes and PAYG withholding purposes, and looking at a few things that have come out of some cases that have occurred in the last couple of years. It's an issue that's very relevant for businesses and employees and also advisors when advising clients. So I'm going to go through that in a bit of detail. I'll quickly cover off on rental properties as it continues to be an ATO focus area. So I'm just going to cover off on a few of the things that the ATO has highlighted that they're seeing as common mistakes in tax returns for rental properties. Division 7A, I also just want to touch on the tax and cash flow impact of the increased rate as it has gone up a little bit again for the 2025 financial year. Then I just want to do a bit of a refresher on individual residency, given that we are still stuck with our same complex residency rules, and there has been another residency case recently. So I'll just do a refresher on that in the context of the case. A couple of small business tax incentives, I'll run through those. And then there are a few more recent court cases that I thought would be relevant for everyone. And then at the end, I just want to touch on the new Thin Capitalisation rules. So give everyone a brief overview of the changes, just so that everyone's aware of what they are. So starting off with the employee versus contractor topic. So late last year, the ATO finalised its ruling and its PCG, its practical compliance guideline on the classification of workers as employees or independent contractors. And this was, as I said, following some court cases that have come about in the last couple of years that have dealt with whether a person was an employee for superannuation guarantee purposes. Now, remembering that for super guarantee purposes, there is an extended definition of employee, where it's basically just anyone who is engaged wholly or principally for their labour. So that's quite broad, and it can encompass a whole lot more people than what the definition of an employee does for PAYG withholding purposes. So the tax ruling is TR 2023/4. And it emphasises an objective assessment of the totality of the relationship between the parties based on the terms of the written agreement. This one, it's important to note that this one is not binding for super guarantee purposes. So still need to separately consider the extended definition of an employee there. The PCG 2023/2 outlines the ATO's approach for directing compliance resources in considering the correct classification of workers. So it provides a risk assessment framework, which I will touch on shortly. So with the tax ruling, as I said, this goes through who an employee is for PAYG withholding purposes. And the first point that I just wanted to make with this is the fact that a worker may be conducting their own business, including having an ABN, is not determinative. So I still, unfortunately, hear a lot of people say that they're just going to work under an ABN because then so-and-so doesn't have to worry about paying them superannuation. And I can't stress enough that this is just definitely not the case, and it's not a choice that's able to be made in that way by the worker and the employer. If you're an individual and you've got an ABN and you are working for your labour, then you are most likely going to be entitled to superannuation, and the employer is going to have to pay you that superannuation. So the ruling goes through it that the first step in determining the nature of a relationship is identifying the contract, which may be wholly written, wholly oral, or a combination of both, with terms implied by conduct. So identifying the contract is sort of a bigger job than what it sounds. It's not just the written contract. It might be that there are some terms that are present in the employment relationship, in the way that the employer and the employee conduct that relationship, that are not necessarily in the written contract, that need to be considered as well. So that next point there that says things external to the contract known to the parties at the time of contracting can be considered. So it's the ATO is likely to definitely read a contract, but also going to question further and look at the actual conduct of the parties to work out or get a better picture of the contract as a whole. So a few common indicators that the ATO will look at is the right to control. This is often a key indicator of employment. However, it does cover that the concept of control should reflect modern working arrangements, which often have increased flexibility. So just because you're allowed to work from home a couple of days a week, or even if you are able to say, okay, I have to go to this appointment during the day and it's going to take a couple of hours and I'm going to make up my time later. That's just, that's general flexibility that modern working relationships have, and it's not necessarily an indication that you're not an employee, or it's definitely not an indication that you're not an employee. So that is touched on in the ruling as well. The ruling also states that the hourly remuneration is often consistent with an employment relationship. So if you're paid by the hour, that is also an indicator that it's an employee, not a contractor relationship. And also the ability to subcontract and delegate is generally inconsistent with an employment relationship. So there was a case on that last year, I think it was with a university lecturer, where they had a right to delegate. There are a lot of other factors that pointed towards it being an employment relationship, but the fact that they had the right to delegate and subcontract made it a contractor relationship. And also it's important to note that a contract's validity can be challenged as a sham if all parties to the agreement have no intention to create the purported legal relationship. So you can't just go and put something in writing in a contract to get a certain outcome, a certain tax outcome, and then go and do the complete opposite of that in practice. So the ATO will look at the contract and the actions of the parties to determine the terms of the relationship. So next, I just wanted to have a look at the practical compliance guideline, which outlines the ATO's compliance approach to classifying workers as employees or independent contractors. This one is relevant for both PAYG withholding and superannuation obligations, and it basically outlines 4 risk categories and advises what compliance resources will be allocated to each risk category, and then also provides some criteria as to how you can meet each of those risk categories. So there's a very low risk and a low risk category. So for the very low risk category, no further compliance resources will be applied if you meet those criteria. If you're in the low risk category, then compliance resources may be applied to test whether the worker meets the extended definition of employee under the Super Guarantee Act, but not for PAYG withholding purposes. If you're in the medium risk category, then compliance resources will be applied to test whether the worker is an employee under the ordinary meaning, and also whether they meet the extended definition of an employee under the Super Guarantee Act. However, the medium risk arrangements will be given lower priority than the high risk. So high risk is essentially the same. There's going to be compliance resources dedicated, but you're more likely to get pinged if you're in the high risk category. They're going to have a higher priority, and also you may be subject to higher penalties if you're found to have incorrectly classified your workers and you're in this high risk zone. So this table is taken straight from the PCG, and it just goes through the criteria that you have to meet under each category. So to cover off on the very low risk category, in order to fall into this category, you have to have a comprehensive written agreement that governs the entire relationship between the parties. So before, I was talking about that the ATO will look at a written agreement, but they'll also look at other potential terms of the relationship that may not be in the written agreement. But if you want to fall into this low risk very low or low risk category, the written agreement needs to be comprehensive, which means it needs to contain all of the terms of the employment. So it needs to be probably quite a large document. And to fall into the very low risk category, there also needs to be evidence that both parties understood what the workers' classification meant and what the tax and super consequences of that classification would be. And also importantly, a business relying on the guideline, if you look down to point 7, needs to obtain specific advice confirming the application of the extended meaning of employee under the Super Guarantee Act and communicated the outcome to the worker. So you actually need to have obtained specific advice to fall into this category. And then also to fall into the very low and low risk category, just looking at point 6, you need to have obtained specific advice confirming that the classification was correct. So that's for the very low and low risk category, and that's referring to just the general definition of employee, not the SG definition. So that's sort of the difference between the very low and the low category. For the low category, you need to have advice for both the general definition and super guarantee purposes. If you don't have any advice at all, then, and you don't have that comprehensive written agreement, then you will likely fall into the medium or high risk category. So if you've got a situation where you've got employees and contractors and you're not really sure, you think you're a little bit on the edge of, it could be either one, it's definitely worth obtaining that advice to reduce your risk. So just running through the consequences for the employee and the employer. Where the worker is an employee, the consequences for the engaging entity are that you must report via single touch payroll, you must withhold amounts under the PAYG withholding regime, you must make super contributions, meet fringe benefits tax obligations, and you're obviously not entitled to claim GST credits for wages paid. And then the consequences for the worker would be that they're not entitled to an ABN in relation to that employment and not entitled to register for GST in relation to that employment. And then where the worker is an independent contractor, the consequences for the engaging entity is that you must report via the taxable payments annual reporting. So you might have heard this referred to as a TPAR report. So no single touch payroll, but you still must lodge that TPAR report each year. If the worker satisfies the extended definition of employee for super guarantee purposes, then you will still be required to make super contributions, and that is really important, not to assume that just because you've got a contractor, you won't be liable for that. very much may be liable. And if the engaging entity and worker are both registered for GST, then you're eligible to claim GST credits. And in addition, if the worker doesn't quote their ABN when required, then you are also required to withhold what's known as ABN withholding tax under the withholding regime. And then the consequences for the worker, where they're an independent contractor, is that they need to make provision for income tax through PAYG instalments if required. So if their income's high enough, then they'll need to pay PAYG instalments. That's important to remember. I think maybe a lot of people, when they're starting out in their own business, maybe don't budget for tax properly. So that is an important one to make sure that your clients are aware of. They're entitled to an ABN and also to register and pay GST if required. So generally, if their turnover is above the $75,000 threshold, and they'll also need to consider the personal services income implications. So there was also just a couple of decision impact statements that were issued after a couple of cases which looked at an employee for super guarantee purposes. So I just wanted to very quickly cover off on a couple of the key points on these decision impact statements. I think I spoke about the cases themselves in the last tax update webinar. So just a quick reminder of the definition of an employee under section 12(3) of the Super Guarantee Act, that if a person works under a contract that is wholly or principally for the labour of that person, then the person is an employee of the other party to the contract. So in the JMC case, this was the one that I mentioned before, where there was a university lecturer who ended up not being an employee for SG purposes because of their right to subcontract and delegate. So the decision impact statement basically, just jumped forward. So the existence of a contractual right within a contract that allows a worker to delegate, subcontract or assign their work to another will result in the contract not being either wholly or principally for the labour of the worker. And where this occurs, the worker will not fall within the extended definition of an employee under section 12(3). And that's subject to the contractual right not being challenged as being a sham. And then the second one was the Jamset case, which was there was some truck drivers who I think they were initially engaged individually in their own capacity, but later on this changed to they formed partnerships with their wives, and the partnerships were the entities engaged rather than the individuals. So the decision impact statement on this case confirms that only a natural person who enters into a contract in that capacity can be deemed to be an employee for the purposes of the Super Guarantee Act. So just moving on to rental properties. This is once again an ATO focus area, and that's because the ATO is finding that the majority of rental property owners are still making mistakes in their tax returns, and that's even where they are using tax agents. So the most common mistakes that they're seeing are that there are overclaimed deductions and a lack of substantiation and not understanding what expenses can be claimed and when. In particular, not correctly distinguishing between repairs and maintenance versus capital expenditure, claiming interest on loans that have been used for private purposes. So if you've got funds from a loan that have been used for private purposes, or the loan account's been tainted, then the interest expense needs to be apportioned, and you can only claim the portion of that interest that's related to the rental property. Also, that borrowing costs must be claimed over the shorter of 5 years or the life of the loan. They can't be claimed upfront. And also the ATO emphasises that they do receive data from banks, land titles officers, insurance companies, property managers and sharing economy providers, and they cross-check this information with tax returns lodged. So that is how they are picking up on on the mistakes that are being made in the tax returns. So just a key takeaway here that to please, if you are using a tax agent, if you're a client and you're using a tax agent, make sure that you provide full records to your tax agent of expenses. And if something doesn't make sense, please ask us, as there may just be a misunderstanding. And we can't read minds, so we might have a receipt, but we also need to, sometimes we need a bit more information than that. So we may ask some further questions of you, and for the practitioners out there, making sure that we are asking questions of our clients where necessary, so that we're not making those mistakes. So I just wanted to touch on this quickly. I think I also touched on this in my last webinar. The Division 7A interest rate previously, a couple of years ago, I think it was 4.27%. It then went up to 8.27%, I think, for the 2024 financial year, and it's now just gone up a little bit again as of 1 July 2024 to 8.77%. So these couple of tables here just show the tax and cash flow impact of this. So using 3 different loan amounts, but if I just look at, if you've got, say, a $1 million Division 7A loan, your minimum yearly repayment is likely to have gone up from $171,000 to $197,000, so about $26,000, which is a fair chunk of money. The interest expense would have gone up by about $40,000, and remembering that this is assessable to the company, so there is going to be additional tax to pay on that interest, and you're not always necessarily going to get a deduction for the interest on the other side unless the loan funds are used for an income producing purpose. And then I've just got there the grossed up franked dividend. So if you're meeting the repayment by way of a dividend, that dividend is going to be taxable to the shareholder of the company. So that dividend for $1 million loan is going to have gone up about $36,000. And the tax difference there is about $6,000 if that's being taxed in an individual's tax return at their 47% marginal rate. So looking at this, I think the important thing to consider is whether there is an alternative to a Division 7A loan, so whether there's some other way to finance or to meet your financing needs, or some other strategy that can be implemented to minimise the Division 7A loans. So yeah, if you're a client, please feel free to reach out to your advisor if you're concerned about this, if you think it's costing you a lot of money or you think it's going to, and advisors, please make sure that you are looking at your client's affairs and considering whether there is an alternative to Division 7A loans. Now, individual residency, I don't want to spend too much time going over the rules, but there was a recent case that I was just going to run through. So in the context of that, I just wanted to touch on just a refresher of the individual residency rules, and also because you may recall that there were some proposed changes to these rules that are supposed to simplify it for all of us, but we haven't had anything further on that, so that's not yet law. So we are still stuck with these complex rules. So there was a tax ruling in 2023 that consolidated and replaced a bunch of other rulings to account for recent case law developments. It doesn't change the overarching principles of the current residency tests. There's no bright line test, and all the facts and circumstances need to be considered. So based on a person's connection to Australia, it's based on a person's connection to Australia, and it outlines 4 alternative residency tests. The first one being the ordinary concepts test. So you're a resident if you meet any one of these tests. The ordinary concepts test looks at whether your presence in Australia is usual and settled, in contrast to temporary or casual, but it doesn't need to be permanent. And that's important to note for the next case that I'm going to talk about. So it looks at your period of physical presence in Australia. It looks at your intention or purpose of presence, your behaviour, your family and business or employment ties, the maintenance and location of assets, and social and living arrangements. The next test is the domicile test. So it looks at, you can have a domicile of origin and a domicile of choice. However, to acquire a domicile of choice, you must have lawful physical presence in a foreign country and an intention to make your home indefinitely in that country. Otherwise, Australia will remain as your domicile. And looking at your domicile, a couple of things that will be looked at is the nature of the accommodation that you seek overseas, and also temporary versus permanent visas may have an impact. It's also the 183-day test, which basically looks at whether you've spent more than half the year in Australia. This can apply unless the Commissioner is satisfied that your usual place of abode is overseas and you do not have an intention to take up residency in Australia. So even if, basically what's that saying is, even if you have been in Australia for more than half the year, the Commissioner may still decide that your usual place of abode is overseas. So again, you still need to look at all the facts and circumstances of the situation. And then there's also the Commonwealth Superannuation Fund test, which applies to some Australian government employees working abroad, but this is now closed to new members, so I find it has fairly limited application. So the proposed rules came from a consultation paper which was issued in July last year, and it proposed a primary test and some secondary tests. The primary test was whether a first person was physically present in Australia for 183 days or more in any income year. So basically that was going to be a bright line test. If that was the case, then you were an Australian resident. But if that wasn't the case, you'd then have to look at some secondary tests. They seemed to be simple to determine, but when I recall when I looked at that at the time, it seemed difficult, like it would be difficult to become a non-resident. There were separate tests for ceasing and commencing residency. And if you had spent more than 45 days in Australia, then it was possible that you could be a resident subject to other tests. But please note, these rules are still not law, so we've still got the old rules. So now just looking at this recent case in that context, the taxpayer was a mechanical engineer who transferred to Dubai in September 2015. His wife initially accompanied him, but eventually spent most of her time in Australia, and that's because their three daughters remained in Perth, two of them being at university and one in her final year of high school when the father initially transferred to Dubai. The most time that he spent in Australia was 47 days in a year, so not much. And I'll just also let you know now that this taxpayer was deemed to still be an Australian resident, so despite only spending 47 days in a year in Australia. And that was because he still owned the family home in Western Australia and also two other properties in New South Wales which were rented out. Obviously, his family ties were very much in Australia. And he also maintained a bank account in Australia to manage the properties and provide financial support to his daughters. He maintained Australian private health insurance, and the AAT affirmed that the taxpayer remained a resident of Australia as they maintained an intention to return and an attitude that Australia remained home. So in this case, the ordinary concepts test and the domicile test were relevant to the decision. Okay, so next, I just want to run through a couple of small business incentives. So the first one is the energy incentive, which is separate to there was a skills and training boost and technology boost incentive so not to be confused, this is a third incentive, but it's structured in a similar way. So the energy incentive applies to small and medium businesses with aggregated turnover of less than $50 million, and you will get a bonus deduction equal to 20% of the cost of eligible assets, improvements to existing assets, and that support electrification or more efficient energy use. And I'll go through sort of what that means shortly. So that is effective from 1 July 2023 to 30 June 24. So it'll be applying in tax returns that you're starting to lodge now after the end of the 2024 financial year. And it will apply to things such as electrifying heating and cooling systems. So this is taken from the ATO guidance on this incentive. It can apply to upgrading to more efficient appliances and equipment, for example, fridges and induction cooktops. So if you're upgrading to an appliance that was more efficient than the previous version of that appliance that you had, then you can claim this incentive. Installing time shifting devices which allow electrical appliances to operate at off-peak times, and installing batteries and heat pumps. So it can apply to up to $100,000 of eligible expenditure. And so then the maximum bonus tax deduction that you can get is $20,000. So 20% of that 100,000. It generally applies to anything that will enable something to be more energy efficient. So it applies to assets where one or more of these 3 points applies. So either there is a new reasonably comparable asset that uses a fossil fuel available on the market, so it needs to be available for you to easily buy. The asset is more energy efficient than the asset it is replacing. And if it's not a replacement, it needs to be more energy efficient than a new reasonably comparable asset available on the market. So it's going to be an interesting one to substantiate. I suppose for purposes of keeping work papers and records, you're going to need to have, you're going to need to have done your research. If it's not replacing an asset, you're going to need to have done your research to check whether there is a less energy efficient option than what you've purchased. And if it is replacing an asset, then we need to make sure that we keep records of the previous asset and be able to show that the new asset is more energy efficient. So yeah, that's definitely something that clients will have to speak to their advisors about, especially if you have made some significant purchases. And also just to touch on, as I mentioned before, the technology investment and skills and training boosts, which apply in a similar way. However, the technology investment ended on the 30th of June 2023, so everyone's probably hopefully lodged their 23 tax returns by now, so that one's sort of gone and done. But again, that was a 20% bonus deduction. And then the skills and training boost applies up to 30 June 2024, so that will still be relevant for 2024 tax returns. The only difference with this one is that it's unlimited, so there's no $100,000 limit. It can be, you can apply it to as much expenditure as you like. However, it must be on external training courses provided to employees, provided by registered providers, and there are a couple of websites there where you can check whether the provider is a registered provider to ensure that you can claim the incentive. And the other small business item that I wanted to just cover off on was the instant asset write-off. So as you all know, we've had a bunch of different measures regarding writing off assets. So there's the instant asset write-off, and then we also had the temporary full expensing measures, which was a completely separate set of legislation. And now that temporary full expensing has ceased as of 30 June 2023, we are now back to the instant asset write-off rules. So just to recap on the last several years, I suppose, before temporary full expensing came in, we had a $20,000 instant asset write-off, and then which was increased gradually. So from January 2019, that increased to $25,000. It then increased to $30,000. From there, it went up from March 2020, it then went up to $150,000. And then following that, the temporary full expensing measures came in where you could write off an asset of an unlimited value. So now that that is finished, we are back to these instant asset write-off rules. So I just wanted to note that the original instant asset write-off under the legislation is actually $1,000. So that's been increased again for the 2024 financial year to $20,000. So technically, without any law implemented to keep further increasing that, the instant asset write-off limit would revert back to $1,000 each year. So it has been proposed to increase it to $20,000 again for the 2025 financial year, but that is not yet law. So at this stage, $1,000 for 2025, unless it gets increased again to the $20,000. All right, so now I just wanted to go through some recent court decisions, which I thought were relevant to hopefully everyone listening to the webinar. So the first case is the Bendel case, which was decided on the 28th of September 2023. This case is also on appeal at the moment, so the decision very much may change. But to just quickly go through the facts briefly, the Stephen Bendel 2005 Discretionary Trust, so we'll refer to that as the SB Trust, made beneficiaries presently entitled to trust income for the 2013 to 2016 income years. The taxpayers in the case are the beneficiaries of the SB Trust, being Mr. B, and a corporate beneficiary being Gleewin Investments Pty Ltd. So entitlements, the entitlements of the corporate beneficiary Gleewin remained substantially unpaid by Gleewin's lodgement day for each income year, and Gleewin has not called for payment of the UPE. So ordinarily, if we have a UPE to a company and it remains unpaid, that generally gets converted to a loan in the next year, a Division 7A loan, and then minimum repayments are required to be made on that loan. And that is because the mere UPE sitting there that hasn't been satisfied is defined as financial accommodation. So essentially the company is providing the trust financial accommodation by allowing them to not pay out the UPE. And that is a Division 7A loan. So the accounting records for the trust also showed that it made significant payments to Mr. Bendel, recorded as an amount owing to the trust. So essentially there were also loans owing between Mr. Bendel and the trust. So the Commissioner issued amended assessments to the taxpayers for the 2014 to 2017 income years, being the years where the UPE would have been converted to a loan, so converted to a loan in the year following the unpaid present entitlement. And this was on the basis that the outstanding amounts represented loans from Gleewin to the trust pursuant to Division 7A that were taken to be dividends paid to the trust. So as you probably know, where you've got a loan from a company to a shareholder or an associate of a shareholder, then you need to put in a Division 7A loan agreement, and if a loan agreement isn't put in place and the amount isn't repaid, then it's deemed to be a dividend accessible to the trust. So the beneficiaries entitled to the trust's income then had a corresponding proportion of each deemed dividend included in their accessible income. So a quick diagram for those who like pictures. We've got the SB Trust, who made distributions to Mr. B and Gleewin Investments, which remained unpaid to Gleewin Investments. So there was a UPE there. And then what you would think would happen is that UPE gets converted to a Division 7A loan because it would be considered to be financial accommodation, but that was the question, that is the question in this case. So the ATO has issued an interim decision impact statement on this. So the ATO has appealed the case, unsurprisingly, and that's because the Bendel decision challenges the ATO's established view in TD 2022/11, which treats these UPEs as loans for Division 7A purposes. So unsurprisingly, as I said, the ATO has appealed the decision and released an interim decision impact statement. The ATO states in this decision impact statement that until the appeal process is finalised, that the Commissioner does not intend to revise the current ATO views set out in that tax determination. So essentially, the ATO does not intend to follow this Bendel decision at this stage. They intend to continue to administer the law on the basis that Division 7A does apply to these arrangements. So it will be interesting to see how that appeal goes. So very much on that basis, definitely we still need to be treating these arrangements as Division 7A loans for at this point in time. So it's also important to note that this case only applies where the corporate beneficiary has not called for payment of its entitlement. If the trust has also lent money to other parties, then there will still be Division 7A implications. So that's where there's a UPE to a company, but then the trust has paid the money to other beneficiaries. And I'll just also note that in that situation, you may also have Section 100A issues because the cash hasn't flowed to the beneficiary and it hasn't been retained by the trust. It's gone to the benefit of somebody else. And also that this decision is only applicable in a very simple situation where the only transaction in question is a distribution from the trust to the company, which has not been called upon, and where the trust has reinvested the funds in its own activities and not on lent it to other parties. So at this case, at this stage, this case does have very limited application until we hear the appeal. So the next case is regarding self-education expenses. I feel like we've had quite a few cases on self-education expenses come out over the last year or two or so, and the ATO is getting a lot stricter on what it is. It's getting a lot harsher and doing and assessing and auditing a lot more self-education expense claims. So the facts of this case were that the taxpayer was an overseas qualified dentist who worked as a dental technician in Australia. They wanted to qualify as a dentist in Australia, so in order to do that, they had to do some extra study and undertake some exams. Over a 5-year period, she claimed the cost of the assessments and exams and also the associated costs such as meals, accommodation and flights for travelling to undertake the exams. The AAT agreed with the ATO that the assessments and exams were not required to maintain or improve the taxpayer's skills as a dental technician. So even though a role of a dental technician is very much related to the role of a dentist, it is a different and separate job. So because these exams were in order to obtain a new role, a different job to the dental technician role, they are not deductible as self-education expenses. Because there's not a sufficient correlation to the taxpayer's role as a dental technician. I've currently got my partner at home at the moment keeps telling me that he's going to claim his Masters of Psychology course when he becomes a counsellor. And I keep trying to tell him that a counsellor and a psychologist, I'm pretty sure, is a different job. So I actually read this case to him this week just to give him an example of what I'm talking about and why he very much probably won't be able to do that. So the essential character of the costs was to obtain, as I said, registration as a dentist, and they're incurred at a point in time too soon to be regarded as gaining or producing the taxpayer's assessable income as a dentist. So she would have already had to have been working as a dentist basically to claim these costs. However, she couldn't work as a dentist until she'd done these exams. So unfortunate situation where she's sort of never really going to be able to claim those costs. And also the last point there is that there was no clear evidence that it led to the taxpayer's pay increases as a dental technician. So just basically a reminder that we need to be really careful when claiming self-education expenses, and where we've got clients claiming them, we need to make sure we're asking a lot of questions to make sure that it's allowed. This next case was an FBT case where the otherwise deductible rule did not apply to FIFO travel expenses. So relevant for FBT purposes and also for deductibility purposes as well. So the facts of the case, the result of the case is basically that the full federal court held that FIFO workers wouldn't have been allowed a deduction for the expenses of travelling to and from a remote work site had they incurred those expenses themselves. So Bechtel was involved in construction of LNG plants and related facilities on Curtis Island, which is only accessible by sea or air. So many workers operated on a FIFO basis. Bechtel organised and paid for the employees' travel arrangements. So those arrangements involved flights to Gladstone Airport from a point of origin, so probably from their home, and then a ferry to Curtis Island and a bus to temporary accommodation on the island. The travel expenses were treated as fringe benefits. However, the taxpayer argued that the otherwise deductible rule would have applied, meaning that they're arguing that the employees would have otherwise been able to claim a tax deduction for those expenses in their personal tax returns if they had incurred the costs themselves. And so therefore, in applying that deduction, the fringe benefits would be reduced to nil. So that the court held that under the terms and conditions of employment, that they were not rostered on for duty until they started work on Curtis Island, and therefore the travel expenses would not be deductible because it's essentially home to work travel, which is not deductible. And this was another sort of FBT case. So it looked at some non-cash benefits provided by a family business to essentially beneficiaries of the trust, and those beneficiaries were also directors of the trustee company, has treated them as not fringe benefits because those individuals weren't employees of the business. So remembering that for there to be a fringe benefit, it needs to be a benefit provided to an employee as defined in the FBT Act. So the benefits that were provided were the use of luxury motor vehicles, which were purchased in the business, and they were made available for use by the three directors who were brothers, so directors of the trustee company who were also beneficiaries of the trust. And the commissioner was of the view that the taxpayer was liable to FBT on the value of the non-cash benefits provided to the three directors. So this actually ended up being a win for the taxpayer. The taxpayer objected and then sought a review when the objection was initially disallowed. So the issues in question were whether the three directors were employees for purposes of the FBT legislation and if they were employees, whether the benefits were paid in respect of that employment. The evidence of the case pointed away from an employment relationship. They had never been paid any salary or wages, and it was also decided that even if they were found to be employees, that they were helping themselves to benefits because they genuinely believed that they were entitled as beneficiaries of the trust, not because it was a reward for their work as directors or employees. So therefore, FBT didn't apply to these benefits. So this is just a warning that this could also work the other way, where if you've got a small, it's a family business, say operating in a discretionary trust, and say it's just the one person involved in the business, they've got a vehicle, let's say they've got a work ute or something like that in the trust, and they want to use the FBT exemption for work utes, where as long as the use of that ute is minor and infrequent, then FBT won't apply to it, and deductions can be claimed for the running expenses of that vehicle. However, you can't use an FBT exemption unless it's potentially going to be caught by the FBT rules. So the person needs to be an employee of the trust. So if they're just receiving a distribution from the trust each year and they've never received any salary and wages, you need to be careful as to whether there is an employment relationship for the individual receiving the benefit, because you may not be able to apply that exemption, and then you may have issues claiming a deduction for the costs as well. So just a note there to be a bit careful with that. So I think we are almost at the end. So the last thing that I wanted to just touch on was the changes to the thin capitalisation rules, which were announced as part of the 2023 budget. So these apply from the 1st of July 2023. So 2024 financial year is the first year where this is going to apply. So we're probably going to be dealing with it a lot more shortly, given that tax returns for the 2024 financial year will be starting to be prepared. So the thin capitalisation rules apply to most multinational businesses operating in Australia with at least $2 million in debt deductions, and that's including debt deductions from associates. And there's 3 new tests that have been announced. So I just want to briefly run through these, not in too much detail, but just so that you know enough to know whether you've got an issue or if you've got a client that might have an issue, and whether it's something you need to look into further. So the first test is a fixed ratio test, and it's an earnings-based ratio test, which limits an entity's net debt deductions to 30% of its earnings before interest, tax, depreciation, amortization. And then any debt deductions exceeding this 30% limit will be denied. However, under this test, the denied deductions can be carried forward and claimed in subsequent income years, and that's for a maximum, they can be carried forward for a maximum of 15 years. Now, this is the default method to use unless you elect to use one of the next 2 methods. So number 2 is the group ratio test, and it's an earnings-based worldwide gearing ratio test. So an entity might elect to use this test if it's a more highly leveraged group, and it's based on the financial ratio of the worldwide group, not just the single entity. It limits the net debt deductions using the ratio of worldwide group's net interest expense and EBITDA, but under this one, you can't carry forward denied deductions. And then the third test is a third-party debt test, which limits debt deductions to those attributable to an entity's external third-party debts. So this replaced what was previously known as the arm's length test, and debt deductions attributable to related party debt are denied under this test. So rather than being that ratio, or essentially you apply a ratio, but any debt deductions which relate to related parties will automatically be denied. And again, under this test, there's no carrying forward of the denied deductions. So that brings me to the end of the webinar today. I hope everybody got something out of it. And again, if you do have any questions about anything that was discussed today, or there's just anything that you want to discuss further or that you're a bit concerned about, please do feel free to reach out to me via email, or feel free to give me a call using my details there. So I hope everyone enjoys the rest of their afternoon. Thank you for listening.